First of all, the stock market was positive pretty much all day today. I mean, we didn't close on the highs, but the S&P 500 closed at a new all-time record high, up almost 0.5%. The fact that it was even positive at all, right, in the face of such bad inflation numbers is perplexing a lot of people, but it makes perfect sense to me because I think that people are buying stocks as their inflation hedge of choice. So it's not, again, as I explained in my last podcast, that the stock market going up proves that we don't have to worry about inflation. I think it proves the opposite. The stock market is being driven by inflation and by the fears that the Fed is not going to be able to control inflation. And so people are buying stocks. Now, the sensible thing to do, though, would be to sell bonds, but that's not what's happening. Bond prices actually rose today and yields declined. The yield on the 10-year closed the day at just below 1.46. On the 30-year, we closed at about 2.15. Again, these are ridiculously low numbers. How can you have a yield of 1.5%, less than that on a 10-year, when we already have year-over-year CPI inflation of 5%? And if you annualize the first 5 months of this year, we're looking at 6.5% and probably more, because again, the back half is going to be worse than the front half. Who in their right mind would be buying these U.S. treasuries, loaning money to the U.S. government for 10 years for 1.5% interest in a 6% plus inflationary environment, right? It doesn't make sense at all. The only theoretical explanation, other than the fact that, the market is completely broken, is I think some people are looking at the increase in prices and correctly concluding that this is a headwind for the economy, that if prices really go up, it saps purchasing power. If consumers have to spend more money on food and energy and stuff like that, they have less discretionary income, and therefore spending in other areas is curtailed, and so the economy slows down. In fact, it's possible, and in fact probable, that if prices go up enough, it could cause a recession. And so I think what bond traders are thinking is that these high prices will actually cure high prices, that it will solve the problem in and of itself, because they think that high prices will cause a recession, and then the recession will cause prices to fall. And so the inflation is going to go away because a recession is going to put an end to the price increases. But that's because they don't understand inflation. It has nothing to do with economic growth. It's money supply growth. And in fact, if higher prices undermine economic growth and even engender a recession, the Federal Reserve will respond to that by creating even more inflation, by printing even more money. So as I said before on this podcast, the weaker the economy gets, the stronger inflation is going to be. So if people are buying bonds because they assume a weakening economy is going to put out the inflation fire, they're wrong. A weakening economy is going to throw gasoline on the inflation fire. People still don't get it that this is stagflation. And of course, where they really don't get it is in the gold market, not just the bond market. In fact, the initial reaction, again, just like clockwork, the minute we got a hotter than expected inflation number, traders sold gold. In fact, I think the algorithms are already programmed. The minute they see the number, they hit the sell button, and gold was down almost $20. Now, before the number was released, I think it was down $7 or $8. So gold was already kind of on the weak side. And I think it was weak because traders were expecting a worse than expected inflation number. After all, we've had 4 inflation numbers in a row that were worse than expected. So you might assume that that streak is going to continue, and it did. So I think traders were already ready for that print. And so some of the selling had already happened on anticipation of a hotter than expected inflation number. And so when we got it, there wasn't as much selling. Then, of course, we got a little bit of a buy the news because shortly after gold tanked, it reversed. And in fact, it rallied back throughout the day and really closed on the high of the day. In fact, as I'm recording this podcast, we're up a little over $10. Market closed about an hour ago. So gold is back just below 1900 again, 1898 and change. Silver also up about 23 cents on the day, now at 27.96. So just below 28. So both gold and silver completely shrugged off the hotter than expected inflation numbers. And again, I've explained this seemingly paradoxical reaction in the markets because gold is an inflation hedge. Silver is an inflation hedge. So wouldn't news that inflation is worse than expected cause people to want to buy gold and buy silver? No, it causes them to want to sell it because as we keep getting surprised with bad inflation numbers, traders keep expecting the Fed to react to these surprisingly bad inflation numbers with tighter policy.
Before we continue, help us by smashing that YouTube like button and subscribe now to this channel. This shows the algorithm that you value the information, and it helps us spread this message. Sharing is caring. Please like and subscribe now. Thank you. And now, let's continue.
They're going to raise rates sooner. They're going to taper sooner. After all, they keep telling us that inflation is not a problem, it's transitory, but the data keeps showing that it is a problem, that it's not transitory. And so the markets are trying to brace for the Fed to finally acknowledge that they have an inflation problem and then solve it. And it's the idea that the Fed is going to solve the inflation problem that is pressuring gold. Well, again, I pointed this out. The fact that every time traders make that asinine trade, there is real money coming in buying on that dip. And so I think the markets are figuring this out, that this is not a problem that the Fed's going to solve. It's a problem that the Fed's going to make worse. Now, a $10 move up in gold is not really a big deal, right? Gold stocks were up today. The GDX was up 2.5%. GDXJ up a little better than 3%. Still well off the highs from the 52-week level. So this is not a strong move, but that move is coming. I mean, we are going to have an explosive move up in the price of gold and silver any day. I mean, I don't know. It could be tomorrow. It could be next week. I don't know when it's coming, but all I know is you should be fully invested now in anticipation of this explosive move, right? Because people are going to figure this out en masse and they are going to scramble for the best possible inflation hedge that's out there. And it's not the gold and silver itself, the metal, it's these mining stocks. It's these companies that actually have huge reserves of a commodity that's about to go way up in price. And they're going to be able to mine their gold and silver for obscene profits, which they are going to be able to share with their investors with increasing dividends, which people are going to need in an inflationary environment because the cost of living is going to go way up. So you need an income stream that can go way up too. And I think that is what these gold mining stocks are going to deliver. So before people figure that out, people should be getting fully invested in the sector. Also, there is very little reaction in the foreign exchange market to the worse than expected inflation numbers. And again, intuitively, you would think that higher than expected inflation would be bearish for the dollar. After all, by definition, if there's more inflation, that means the dollar is losing purchasing power faster than holders of dollars had expected. Well, if you're holding on to dollars and they're losing even more purchasing power than you thought, wouldn't that create an additional reason to get rid of those dollars? You would want to sell them before you lost even more purchasing power. And again, what inflation is really measuring is not how much prices are going up, but how much value the dollar is losing. And because the dollar has less value in terms of purchasing power, prices are higher. So higher inflation, by definition, means the dollar is weakening. And so you should see that in the foreign exchange markets with the dollar getting lower. But again, the same phenomena that we're seeing in the gold market, it's these hotter than expected inflation numbers that cause the traders to anticipate the Fed to raise interest rates to fight that inflation. And it's the anticipation of higher interest rates that causes people to want to buy the dollar rather than the fear of higher inflation causing them to want to sell the dollar. But again, we didn't get a dollar rally, which I think is significant because in the past, the dollar has actually rallied on these hotter than expected inflation numbers. And the fact that it did not rally, to me, tells me that it's getting ready to sell off, because if the dollar won't go up, well, then it's certainly going to go down. And it means that people are again starting to realize, just like with the gold market, that higher inflation is here to stay. The Fed's not going to be able to put out the fire. So you better do whatever you can to make sure that you don't get burned.
What to do in such a situation? Inform yourself and keep your financial education strong. We from the Compact Group offer our loyal subscribers a free educational portal with first-hand monetary, financial, and economic knowledge. Enter our invite-only Insider Club by clicking the link below. You will get access to first-class information far earlier than the rest. We have prepared a special deal for all our members where you can access a giant pool of Robert Kiyosaki's financial wisdom for just $1. To find out more, simply click the link below and join our Insider Club absolutely free. But there is more you can and should do. Build up several streams of income. More and more people realize that they have to take their future in their own hands, but they don't know how and where to start. We from Compact offer our Insider Club members unique opportunities. Strengthen your financial muscle and get the edge. Click the link below. Become part of our free Insider Club. No financial obligations. But there's one important thing you have to know. You have to become active. So do it now. Become active and see you on the other side.